welcome. Glad you're with me today because we've got 5 months left in the strangest, craziest, most consequential year the Opportunity Zone world has ever had. And today I'm going to hand you the playbook for the rest of it. Deadlines, deals, and December 31st. That's the agenda. Now, some of you spent yesterday looking at live deals. And if that's you, perfect timing because today is the other half of that conversation. Yesterday was the deals side of the table, professionally managed deals that you could go to. You actually had a lot of great information and stuff, right? That Ask the OZ Expert panel was phenomenal. There was this really good looking guy in there. Just kidding. So there was professionally managed stuff and a lot of information, but today we're going to talk about execution. That's what we do at OZ Pros. We don't just help you talk about it. We don't just help you evaluate it. We help you do it. And we help you keep track of it and make sure that your stuff is tight so that way, if the IRS comes knocking, that you are ready. So today is your side of the table. And I know we've got a mix in the room today. Some of you have a gain sitting in front of you right now. Some of you had a gain potentially all the way back to January 1st of 2025. Some of you are advisors, CPAs, accountants, wealth managers with clients who have gains or who are looking at potential gains down the road into 2.0, and you're looking at what's the strategy, right? And what we're going to cover today is going to make you look very smart on your next client call. So take notes. Some of you are just OZ curious, still figuring out whether this world is for you. Oh, yeah, dude, from whichever walk, it's totally fine. All of it works. If there's a capital gain anywhere in your life or your practice, the next 20 minutes apply to you. And I want you to get your questions ready to roll because we're going to open it up for live Q&A just like we did with Ask the Expert. Here's how this works. I'm going to run the playbook. 4 things. Your personal deadline math. And I promise you at least one date in there is going to surprise you. The fork in the road every investor is standing at right now. Move before December 31st or wait for January. How to pressure test a deal before you wire a single dollar. And if you're already invested, what December 31st actually means for you and what you can do about it. Then we open it up and we take your questions, like I said before. So load up the chat as we go. Whatever you're working through, your deal, your dates, your structure, your client situation, bring it. Don't sing it. All right, let's go. First thing, your personal deadline. Because everybody's starting at December 31st like it's the only date on the calendar. And for a bunch of you, it's not even the one that matters. The basic rule, when you sell something and realize a capital gain, you've got 180 days to invest that gain into a qualified opportunity fund. That clock starts counting on the day of the sale. So technically, you've got the sale date plus 179 more days. So when you're putting it into Claude or you're putting it into your AI bots or into Google search, right? Sell on March 4th, say 179 days from March 4th. Your window runs through August 30th. Real dates, real math. If you sold something individually this spring, go count your days because some of those windows are closing this summer while everybody's at the beach. Now, here's the one that surprises people. If you or your client's gain came through a partnership or an S-Corp, if it showed up on a K1, you don't get one start date. You get 3 potentials. You can start your 180 days on the date of the sale. You can start it on the last day of the entity's tax year. So December 31st for most partnerships or S-Corps. Or you can start it on the entity's tax filing deadline, which once again is for most partnerships in S-Corp is March 15th of this year. That then allows you, right? Do the math on that third one. That allows you March 15th plus 179 days lands you in early September, which means if you got handed a 2025 K1 with a capital gain on it, we're talking all the way back to January 1st of 2025, a gain from a sale that happened last year, a gain that you may have already mentally filed away as taxed and done, and you're getting ready to write the check, or you already did earlier this year, you can still defer that gain into an Opportunity Zone fund. I think that they've probably hit this a lot on pitch day. But your final window closes in early September, which is 6 weeks from right now, not December, 6 weeks. Dude, I talk to people every single week who have no idea this window exists. They paid their April estimate and moved on, and there's a live deferral sitting on the table with a fuse on it. And for the CPAs and advisors on with us, this is the one to go run through your client list this week. Anybody who took a partnership gain last year is holding a September window they probably don't know about, and you get to be the hero. One more date while we're here, October 15th. If you filed an extension this year, well, let's talk September 15th as well. If you filed an extension on your qualified opportunity fund, your return is due September 15th for that qualified opportunity fund. Personally, it's October 15th. That's when your return's actually due, and that return is where your deferral election lives or dies. The gain gets reported and deferred on Form 8949, and your fund position gets reported on your individual Form 8997. Every year, by the way, not just the first year. I've reviewed returns where the investment was fine and the paperwork wasn't, and let me tell you, cleaning up that after the fact is a whole lot less fun than doing it right the first time. So if you are an investor or you're a CPA or you're an investment advisor and you deferred a gain and you're on extension, the election paperwork is not a detail. It's the whole ball game, and you want to make sure that that paperwork is correct. So that's the clock. Sale date plus 179 if you held it yourself. 3 options if it came on a K1. Running as late as early September for last year gains. October 15th for papering it right. Know your dates. Everything else in this playbook hangs off of them. Second thing, fork in the road. 1.0, 2.0. And I get this question more than any other right now. Should I invest before December 31st or should I wait for January in the new program? And they call it a dead zone for a reason, because there's this perception that, OZ 1.0 is dead. I just got to wait till January 1st and I'm going to be able to participate in 2.0. But here's the honest answer for a lot of you. So your sale date will already have answered it, right? So if you're sitting 180 right now, right? So if your sale happened basically before about the 4th of July, your 180 days run out before January ever gets here. That's if it was an individual sale. So your choice is 1.0 now or no opportunity zone at all, right? That's just it's counting days. It's getting the calendar out. So if your gain was after the 4th of July, it actually was technically, I think, July 8th, or is coming later this year, your window reaches into January. Now you've generally got choice. And here's what each door gets you. Door number 1, invest before December 31st into an existing 1.0 deal. Straight talk, the deferral benefit is basically gone, right? It's the same net effect as if you were going to pay the taxes next year, because it's going to be due the same time, because your deferred gain gets recognized on December 31st of this year, no matter when you put it in. So you're deferring for a matter of weeks/months. What you're actually buying is the big prize, though, the 10-year hold and the step up to fair market value on your exit. Tax-free appreciation. That does not go away. And it doesn't go away if you invest between now and December 31st of this year. Here's the part that people miss. A lot of the best real estate in this program sits in 1.0 zones with deals that have already been done, right? Deals that potentially are already cash flowing. These tracks, right, got picked back up, and they got picked back in 2018, and it was based on the 2010 census. And some of them have had 8 years of momentum since, right? They had 8 years from the 2010 census, and now they've had 8 since then. I've seen the new eligibility maps, and in a lot of states, the 1.0 locations are, they're a lot better than what's coming in 2.0 as eligible. A grandfathered deal and a great 1.0 tract is a real asset. So let's reiterate that. Potentially getting into a 1.0 deal is a real asset. The other thing is that if you go into a 1.0 deal, you're going to have the ability to be able to take a valuation discount. Number one, if you're under construction, or if you've got discount for lack of control or discount for lack of marketability. And that valuation discount could be in the 15%, upwards of 50% range based upon what the status of the project is. So it could be a project under construction that is midway through construction, which is probably going to generate almost a 50% reduction in value on paper in and of itself. And this is the key, is that the valuation is performed as of December 31st, 2026. And so it is then, what's the value of your QOF investment worth between a willing purchaser and a willing seller? Well, I can tell you that there's not a whole lot of market out there for 1.0 interests as of December 31st, 2026. Because door number two is that if you had a gain where you can choose, a lot of people are looking at that and they're thinking that they're going to wait for January. The new program kicks in January 1st. The first banking day, I think, is January the 4th, right? Because January 1st is on a Friday. So anyhow, I think it's the 4th. And so you get a rolling 5-year deferral, actual meaningful deferral, right? So let's not discount 5 years of an interest-free loan from the government. Actually, it's a negative interest loan from the government because they're going to give you a 10% reduction when you go to pay the taxes and potentially a 30% reduction if you're in a rural fund. That's real money. And you still get the same 10-year tax-free exit. So the framework is this. Earlier gain, your path is 1.0 or nothing. And the question is whether the deal itself is worth it and whether you could potentially take a valuation discount. Later gain, you're choosing between a proven location now and potential valuation discount versus the 5-year deferral and the reduction if you invest in January. And if you're sitting on an asset you haven't sold yet, when you sell, just became a strategic decision because the sale date picks which program you're eligible for. Well, if you're selling after this webinar, you're going to be eligible for either going into 1.0 or 2.0. And so that one, right? So deciding about whether you're going to sell and whether you're going to put it into a 1.0 deal for the valuation discount, potentially upwards of saving 50% at a known tax rate, that's actually a real conversation. And you're going to want to talk with somebody who does this every day, because I can't give you a blanket answer from a webinar, but anybody who says that they can, they're selling something, right? We're going to do a deep dive and we're going to walk through what maybe your best circumstance is. Now, if you're on the earlier side of all of this, no gain yet, just watching, this fork is exactly why you're smart to be learning it now and why why it's good that you're on a webinar where you're specifically learning about how you could use this program, right, in order to minimize your gain when you ultimately pay it. Third thing, before you wire $1 into anybody's deal, any deal, including anything that we would be promoting or anybody else, there are 2 questions that tell you whether that project is going to be viable. And almost nobody is asking about them. Question 1, is the project's track likely to be on the new map? Here's the background. The IRS dropped Notice 2026-40 a few weeks back, and it changed the game for 1.0 projects. Well, it's not permanent in the regs yet, but it could be a game changer. So the new 2.0 zones get designated. They're literally being designated by the governors right now. This summer and fall. Texas is going to release theirs on Monday. Statutory deadline for states to submit their nominations to Treasury is September 28th, with a 30-day extension available, and certifications are expected to roll in through November and December. And listen closely because this matters. Eligible does not mean designated. There are eligibility maps floating around everywhere, and a tract being eligible does not mean that it's going to be nominated. The governor picks, Treasury certifies. Until that happens, nobody's tract, right, in that eligible zone is safe that it's going to be designated. Why does it matter for the deal you're looking at? Because under the notice, if a project sits in a 1.0 tract that doesn't make the new map, new capital can still go in, but it can't buy qualified opportunity zone business property after December 31st of this year unless, and this is the answer to question 2 that you need to be asking, does the project have a written working capital safe harbor plan with real money, at least 10% of that working capital safe harbor before year end? And what's their plan for how they're going to deal with that working capital safe harbor, and how much time are they going to have left on it? Are they starting a new one in December of this year that's going to give them a full potential 62 months? Well, I think it would probably be an existing business. So that would be something to look at, right? As to whether or not and what their plan is for how they're going to deal with that working capital safe harbor window and their thought process behind it. The escape hatch that the IRS gave us in order to grandfather has 3 parts. The fund and the operating business, the QOF and the QOZB, Number one, they've got to exist. Well, technically the fund doesn't have to exist because it could just be the QOZB, but it's kind of hard to be a QOZB, unless you've taken capital gains in or you're planning on doing that. The QOZB then needs a working capital safe harbor plan in writing, and I mean a real one, right? So it needs to be the one that is actually going to lay out what they're going to spend money on, because the project is going to have to substantially comply with that working capital safe harbor plan. Then 10% of that plan's capital has to actually be received into the QOZB before December 31st, and 5% has to be spent or under binding contract all by December 31st. The 10% could be debt, by the way, which is a huge win, because raising 10% in equity on a new project by year end could be outrageously unrealistic for a lot of deals. So when a sponsor is talking to you about their deals, ask them about this. And the ones that know their stuff, the ones that we're talking to, right, we're actually helping them put this into play. So they've got this dialed, right? And so they are prepared to identify and to make sure that they're getting grandfathered in, right? And if they're not, then you need to kind of scratch your head and to maybe think about it. So once again, a sponsor's got crisp answers. They've done the work. A sponsor who waves it off or says, or kind of disregards it, right? Like we want to ask some more questions on that. All right. I want you to know that I'm not talking, right? So I'm not preaching you from, the bleachers right now. I'm not in the choir loft. I'm running this exact play on my own deal right now. For our deal in Wadesboro, we've got to figure out what we're going to do with that property and if we're planning on it, because it's not eligible under a 2.0 tract, right? I've also got a mixed use project that we want to do down in the South Carolina area. And right, I want to make sure that we're grandfathered in on that deal. And that deal is about a $10 million project. And I don't know that the tract is going to get redesignated. Now, that one's eligible. The one in Wadesboro is not, right? But once again, eligible doesn't mean designated. So before December 31st, we are coming up with a full plan for both of those projects. $10 million. Then, because it's $10 million, we got to get $1 million into the QOZB, and we got to have $500,000 either spent or under contract. The 10 and the 5 on a real deal. That's how seriously I'm taking this notice. I'm prepping for it. Now, things could substantially change, right, in the final regs, and we're hoping that they do. I hope the Treasury comes back and says, well, you know what? We're actually going to make this happen on December 31st, 2028. That would be fantastic because it would give us another 2 years of runway. But that's not what came out in the notice, and so we've got to prepare with what we have. Now, here's the timing piece, because this is where people get burned. I used to do mergers and acquisitions, and the rule of thumb was if you want to close by year end, you need bank approval by Halloween. And to get bank approval by Halloween, that term sheet needs to be moving 30, at least 30, usually 60 to 90 days before that. Run that math backward from December 31st, from Halloween, right? 90 days before Halloween. I guess we're right on it right now. Entity structured, budget built, plan written, capital in, dollars committed. That work starts at the end of August. Look at the calendar. That's literally in 30 days. Everybody who waits is going to hit the same wall at the same time in fourth quarter, and some of them are not going to make it through. Fourth thing, if you've already invested in an Opportunity Zone fund, December 31st is your date, and I want you clear-eyed about what happens and what your moves are. December 31st, the gain you deferred when you invested gets recognized. It goes on your 2026 return, payable next April. It cannot be deferred again. That's the other thing that the notice said. And by the way, this stopped being insider knowledge over the weekend. CNBC ran a story on it, $75 billion in deferred gains coming due at year end, 41,000 separate investors, numbers straight from the Treasury. So the whole country just found out what you've known for a while, which means the professionals who handle this are about to get very busy. It's built into the program. It applies to every OZ investor in America. It's not a reason to panic. It's just a reason to plan. Two things you need to know. First, the good news is that the IRS confirmed in that same notice that paying the tax does not touch your 10-year exit. Your step up to fair market value on the back end survives completely intact. You pay what's due on the old gain, right? Less 10% or 15% if you were in by either 2021 or 2019, but your appreciation's still going to walk out tax-free down the road. Second, and this is the one that almost nobody's running the numbers on, the amount you recognize as the lesser of your original deferred gain or what your fund interest is actually worth on December 31st, the lesser of the two of those. So if you invested in 2019, 2020, 2021, and your fund rode through everything the economy threw at these projects since then, your interest might be worth less than the gain you rolled in. You can also take discounts for lack of control, discounts for lack of marketability, because if you're invested into a professionally managed deal, then there's going to be able to support real defensible discounts. If your project is under construction, you're going to be able to take a discount. Now, it's really important that you actually do some preliminary numbers on that before you go down the road. Oh yeah, man, I'm into valuation discount. I'm all over that, because some deals have actually gone up in value. And we're helping sponsors do webinars to explain to their investors that it does not make sense for you to burn us down or for you to go ahead and try to take a discount, because our values have actually gone up. And even though you could take a discount for lack of control, discount for lack of marketability, it's basically going to offset. And so don't spend the money. Don't waste the money on that. And we also want consistency with respect to what our investors are reporting relative to what their value of their QOF interest is worth. So we're helping sponsors manage that particular process right now. Now, for the right situations, for ones that have gone down, that are under construction, or that are, for whatever reason, the economy kicked them in the teeth, that valuation discount can take a pretty big bite out of the December bill, because once again, it's on your original gain or the value of your QOF investment at the time. It's not a fit for everyone. There's a regulatory screen you have to clear first before you spend a dime on that appraisal, and the appraisal itself has to be dated December 31st, which means that this analysis starts now, not in November. We went deep on this exact play at our last session, so if that's you, ask me about it in the Q&A or grab the replay. We've done a couple of webinars on this valuation discount play, but once again, it doesn't apply to everybody. So beyond the valuation question, there's a whole stack of strategies for shrinking what you owe, right? So number one, if you're in by 2019 or 2021, that's going to reduce on top of that valuation discount or in lieu of the valuation discount. In addition to that, we can help you deploy strategies that are going to further mitigate the taxes and lessen the amount that you owe. Now, some of these strategies depend on your facts. Some depend on whether your original gain was active or passive, which, by the way, is a great question to go ask your CPA this week. Hey, is my gain that I had back when I deferred into this QOF, is that going to come out as active or passive? Because if it's passive, we got maybe some more things that we've got access to, because we're not restricted as much, right, relative to that active passive loss limitations. We also have to factor in the excess business loss limitations on having excess business losses to try and mitigate a gain that might not be treated as business gain. Now, here's the reality about timing on all this, and it's the same story as the sponsor side. Once again, every deferred gain in America comes due on the same day. Every 1.0 sponsor needs a plan built before the same day, and they're all going to call the same short list of professionals in October, November, December. Our calendar is already stacking up for the back half of the year. I don't know how many weeks out we are, but it's starting to get real. And this isn't a scare tactic. It's just a scheduling fact, right? So the people, so you guys, because you're here, you guys are aware of this. We need you to raise your hands early and get in touch with us so that we can get the runway to do this right. So that's the playbook. Know your clock. If there's a 2025K one gain in your life or your client list, you got weeks, not months. Know which side of the fork your sale date puts you on. OZ 1.0, 2.0. Pressure test deals. with the map and the plan. And if you're already in, get ahead of the December 31st instead of letting it happen to you. Simplest next step, whatever your situation is, go to ozpros.com/connect and tell us where you stand. Doesn't have to be polished, just the shape of it. Your gain, your dates, your deal, your client's questions, your worry. We'll read it and point you in the right direction. If you'd rather just talk to a human first, book the free 15-minute call, and we'll figure out together what you actually need. And when it's time to map your specific numbers into a full plan, that's what our blueprint sessions with me are for, and we'll tell you if and when that's the right move. All right, let's get into your questions. Chat's open. Let's see what you got. All right, now I'm trying to figure out how to switch me out from that crazy frozen face. I think that I can pin this one maybe. Yeah, there we go. And now go to this. Nope. Man, I don't know how to get rid of that one. Maybe if well, we just leave it down there. We can have you guys can look at that crazy face that I got down there. But exciting. Appreciate you guys being here today. Once again, we got lots of stuff that's going on down in the chat. And we covered a lot of ground. So let's put it to work. Here's how we're going to do it. Ask me anything, your gain, your dates, your deal, your fund, your client situation. If I can answer it in a minute, you'll get the minute. If it really needs specific numbers, I'm going to tell you that straight and point you to the right next step. We got until the top of the hour, so we got, literally we got 30 minutes now. So let's keep the questions coming while we talk, and I'll get through as many as we can. We just did this at the Ask the Expert Day yesterday on Jimmy's pitch day. So, all right, let's roll into it. Okay, first question here, and I think that I can make this, I can pull this on. We could go, and we're going to go 20 seconds on this. But, wow, it's not working on here. Oh, there we go. If you have identified an investment that is located in a possible 2.0 zone and want to make the investment, whether it's an OZ or not, how can the property be acquired this year and maintain the 2.0 benefits if the tract is declared an OZ for 2027, right? It says 2028 there, but it would actually be designated in 2027. Awesome question. If it's not a 1.0 tract and you want to make it an OZ deal, you're not going to be able to buy it until after January 1st of 2027. Because if you buy it now, it's going to be just like you acquired property in July of 2017. It doesn't work. You'd then have to convey it again into your QOZB, and it'd be a related party transfer. Now, if it's raw land, we don't really care about that because we're going to get 2.5x worth of improvements. So we just tuck it into our bad assets store and we go about our business. But if it is, if it's like an actual building, you're not going to want to convert it over. You're not going to want to convey it over because that bad asset, now when you do your improvements to it, those are not qualifying. So if you really want to make it, if it's not 1.0 and you want to make sure that you try to get it into 2.0, the pretty much the only answer is buy it after January 1st of 2027. But Jeff, appreciate the question. Appreciate you being in here. And man, I'm going to give it a shot on this one on pronouncing your name. I'm going to say Sakya Devuru. And I've got 25 cap gains from a partnership of 1.5 million. So his plan is get it into a fund in early September and then take it out in 2 months. Will the gains simply become taxable in 26, moving from 2025 to 26, or will the 25 deferral be challenged? So when you invest into a qualified opportunity fund, you have to have the intention that you're doing so, right, relative to actually making an investment into qualified opportunity zone business property. So if you're just doing it as a deferral, there could be an issue that the IRS could say that is just literally just hunting for a deferral, and that they could say that that's substantially abusive and that you are, and then come after you for that to try to say that it's not a good deferral, which would then make it so that your taxes were actually due in April of 2026. And then also your next deferral into your next deal aren't going to be valid either. And so that then becomes an issue, because when you roll it in 26, now you're going to be looking at, a 5-year deferral on it, and those taxes could get pretty gnarly. And there's no way that you could say, hey, listen, I want to take this deferral and I want to go ahead and pay the taxes, so I cut off the potential penalty liability. And so now I regularly preface this that I do not recommend this, but I had a guy call me and he asked me, he said, he was on a strategy call, which you can schedule, by the way. I think that we've got a link, or it'll be here in the chat, but you could schedule a strategy call with me. And this gentleman was on a strategy call and he said, hey, I've got a gain. I'm at my day 178. I'm not ready to make a decision. Can I go and buy Bell Point right now and then sell that stock, at some point in the future in order to extend out my 180 days? And I said, well, I would not recommend that. But once again, under the regs, technically you can do that, right? So if you invest into a qualified opportunity fund and you ultimately, defer via, that fund, then you're okay, right? You're going to have a deferral, and this would be a way that you could, move the gain into 2026, actually into 2027 under OZ 2.0. And so, it's one of the strategies, and I've seen people, utilize that in order to get more time relative to being able to defer that cash and defer the gain into a fund. All right, so we've got Arthur Landry. Arthur, thanks for being here today. It's good to see you in here again, man. Appreciate you, everything that you're doing for, inside of our community, and also just for the OZ world as a whole. And I love it that the Opportunity Zone program presents a play to be able to get rural, and I think it's a great opportunity. And what, one of the things that Trump is trying to do and the legislator is trying to do within this program is to revitalize businesses in rural America. That's why they put this massive incentive for doing rural qualified opportunity funds, because they want to bring business back to the rural areas. And so, Arthur, this goes into your question. You got a startup rural OZ project. How to explain how to legally structure the most beneficial project for all. How would this be good for attracting investors? So the key thing is that you need to have a really good just business model relative to something that's actually going to work in a rural OZ. So that could be real estate. So that could be, farming. It's actually pretty tough to make, a significant amount of cash from just pure farming endeavors. Let's face it, farming is tough. God bless the farmers that are out there. And so you really want to try to have additional stuff in addition to that farm, maybe where you're using the farm as like a, kind of your amenity for, a hospitality kind of play, potentially a working farm neighborhood. I know that the agri-hoods are really popular right now. And so all of those are candidates inside of this rural area. Key thing is, once again, is that you got to have some kind of business there that's going to be attractive for somebody who wants to invest. And then as a first-time sponsor, you're going to want to make sure that you're well capitalized relative to being able to get professionals who know what they're doing to put together your offering documents. And then you're going to need to tell a really good story. I think that I just went out. Let's see if, all right, there we go. I think everybody can see me. Maybe I also need to just jump in here right now and make sure that everybody can hear me. If you can't hear me, let me know in the chat. Otherwise, I'm going to keep going and answering these questions. That was a great one. And Arthur asked again. He asks, how can I utilize these ideas to find investors for a new to be developed in a rural OZ that was in 1.0 and suspect it will be in 2.0? So if you think it's going to be in 1.0, then I think you're going to be okay relative to going into 2.0. So if it becomes a 2.0 and you thought it was a 1.0, then you should be good, Arthur. All right. Would love it if we could get some, we get some questions in here, right? You're going to knock me into the dunk tank. Ty asked, timing on setting up a captive QOF. The plan is to invest into 2.0 deals. Should I wait until 2027 for setting up a captive QOF? I would go ahead and get your funds set up because you're going to want to have the ability to get that cash into your fund's bank account as early as possible in 2027. And so in order to do that, you've got to go through the process, right? You got to have an entity set up before you can get a bank account. And so in order to get that entity set up, you got to go through the process with us. And we can usually get an entity turned in like 3 weeks, and then we can usually get a bank account set up inside of a week. But once again, if you've got that done prior to the beginning of the year, I would say go ahead and try to get it done. We are logging in a bunch of folks who are doing exactly that. They're setting up their funds, and they're namely setting them up so that way, if they stumble across a 1.0 deal, then they can take advantage of that. And having your QOF and QZB set up is crucial so that way, if you need to get a grandfathered working capital safe harbor plan in place, you've got the entities to be able to do that. All right. So Jeff, appreciate the comment. I'm going to show this one. I've got a captive OZ fund that has investments in multiple QOZBs. I wouldn't expect a discount for lack of control, but what would be the reasonable discount range for loss of marketability due to the OZ holding period? So Jeff, this is the issue when you've got captive funds, right, that then invest into, real estate deals, is that if the value of the underlying real estate deals hasn't substantially gone down, then you're going to have a tough time being able to assert a lack of marketability, right? If you own the QOF and the QOZB, and then it owns an asset, right? And the value of that asset has gone down, then I think that you've got a reasonable basis for pursuing a valuation discount. But if you own it completely and the value of that asset has gone up, then it's really kind of silly to go down the road of a valuation discount because you own it, right? Like there's really not a whole lot of discount that's going to get applied to your membership interest because you have the ability to control whether you can sell that or not. Now, if you were to have done estate planning, and that estate planning put your trustee in there with a consent right relative to either divesting your membership interest or the assets, now all of a sudden there's a lack of control and a discount for lack of marketability. And usually on the conservative basis, we're seeing those combine to about 30%. So just FYI is that if you own it wholly, that there needs to be some kind of, reason as to why you're divesting, right? And as it relates to control issues on being able to get rid of your membership interest. Hopefully that answers your question, Jeff. All right, Chris, welcome. Appreciate you being in here. Have a project now, looking at another in the same track in 1.0. Can I use the same LLC or do I need a new one? Later, can I sell this one and move funds to another project in 2.0 without having to recapture depreciation? So lots of stuff embedded into that. But the answer is that if you're looking at another project in either in 1.0 or in 2.0, you can use the same LLC. So once again, the only reason why you might not want to do that is if you're trying to kind of have vintages relative to the timing of your investment. So if you've got different times when your money comes into the QOF that you want to preserve because you're like, okay, hey, I had one investment come in 2020. Now I've got another one that came in 2024. I want those to have their own separate 10-year holds so that way in 2033, I can exit and not have to, I'm not pinging into my 10 years because that 10 years is significant because once that tranche of capital, that investment for that turns 10 years old, that now triggers your ability to take the step up in basis to fair market value. So accordingly, what most people do is if they're having multiple tranches, they'll set up new QOZBs that they want to have that timing associated with. So have a 21 QOZB, a 22, 23, 24, 25, 26, that kind of thing. And then that way you've got the ability to trace when your capital gains came in for purposes of that 10-year hold. Because that's the key piece, is not whether you need a new LLC for purposes of 1.0 or 2.0. It's more a function of how do you want to track your timing on this. So that goes into the first part of the question. Second part, later, can I sell this one and move funds to another project in 2.0 without having to recapture depreciation? So the answer on that is no. Is that you're going to get hit with the depreciation recapture if you exit prior to your fund investment turning 10 years old. That's why it's so important to keep track of that 10-year hold period, because it has a really, really significant benefit just in the form of avoiding the depreciation recapture. And so that's one of the things that we really want to monitor, is that if we are, if we're really conscious about that, then we're going to want to make sure we're tracking that 10 years. Now, I've seen people do 1031s with their QOZB, where they 1031 into another project as part of a strategy so that they don't get hit with the depreciation recapture. And so that's kind of the answer to the second part of that. Now, if you do sell, you've got 12 months to reinvest the basis into a different QOZB. So that basis goes up to the QOF, and then it can go into a different QOZB, and you've got 12-month period to be able to do that. Any of the gain, you could actually roll in as a new gain under 2.0 and get the 5-year deferral and your 10% or 30% reduction. Now it's going to restart your 10-year clock if you do that, but I mean, I would be all about that. I'd be like, yeah, okay, let me take the gain, let me distribute it out, and then I'm going to put it back into either another QOF or the same QOF, and I'm going to put it into a different QOZB. So that's kind of and we've specifically got a video called Selling Before 10 Years. And I believe that's on YouTube. If you can't find it on YouTube, reach out to us and we'll shoot you that video over, okay? All right, Amy, welcome, Amy. Good to see you in here. What options would someone have to defer the taxes again or roll over into another QOZ that are coming due from originally passive gains? So if you're talking about the gains coming due at the end of this year, you're not able to roll that into another fund. You would have to pay the taxes on it, or you'd have to have an inclusion event prior to that. And then you would then potentially roll that into a fund if you have an inclusion event prior to December 31st, 2026. But if they are from passive gains, then you can use passive depreciation in order to offset that. And so solar is good for that. Pretty much any investment that's got depreciation, even if it's a fund investment, you're going to be able to use those passive gains to offset passive losses. So that's kind of the best of both worlds. And then if you do invest into something that's got active, you could either elect to carry it forward to use that against ordinary income or other active capital gains, or you could use it to offset the passive. So it's kind of the best of both worlds. Like typically people are like, oh man, I got passive gains. Well, that's actually kind of the best kind because it's the easiest one to find appreciation out there that you can use to offset it. We've got a bunch of different tax mitigation structures that we are putting people into right now as part of eliminating this tax it's going to be due or reducing it. It's really tough to eliminate it, but as part of reducing it. And we've got one that's got a $2.5 million threshold that's really, really powerful that gets you down to around 10% as opposed to the 23.8%. On passive, we've got tons of options within that. We've got a equipment rental option that Madison Capital's doing right now. There's also the solar play with Fortified Solar because you can take advantage of that passive depreciation. All right. Now it's funny is that my team, or I guess me, right, on my team says, it talks about AI. One thing you got to be really careful of, AI has gotten a lot better. I mean, when I used to put questions into AI about opportunity zones, it was amazing how much hallucination happened. But it's still hallucinating on different specific items, and it doesn't get those exactly right. And a lot of times what it spits out can be really confusing. So you need to be really careful about AI. The other thing, and this is a public service announcement relative to AI, is that everything that you put into AI, you need to be prepared to have it discovered in the event of litigation or in the event of potential interaction with the IRS. Because by very definition, unless you've got it to where it's not being used to train the large language model, then by putting it in, you have eliminated your expectation of privacy. So there's a couple of court cases that have said that when somebody asks chat or when they ask Claude or whatever your AI is, when you ask that a question, that those both the questions and the responses are discoverable. So when you're asking it crazy questions, right? Like, and people do ask crazy questions, just be cognizant that that could be discoverable later on. Now, if there's something that you need or that you really want legal advice on and you want to run it through AI, it's actually not a bad idea, but just send it to your lawyer, have your lawyer run the query, and then send you back the result. Now that's all covered by attorney-client privilege because the attorney asked it on your behalf. And so that is still attorney-client privilege communication. What you don't want to do is take something that your attorney sent you, put that into AI, because now the entire conversation that you had with your attorney is now not privileged. So Blair asks, Blair, welcome. Does a flow-through bonus depreciation adjust or reset in the actual basis for fair market value in addition to the discount? The answer is that it flows through. Now, when you take the valuation discount, your basis is now going to be reduced to what that valuation discount was. So let's just use a real fast example. That's a great question, Blair, because I'm sure that there's probably a fair amount of confusion about that. And the IRS is smart. They're not going to let you triple dip. And so if, let's say, you had $1 million gain and you want to put that into an active project that's got a valuation discount that's going to happen at the end of this year. Like Madison, we'll just use Madison Capital's Reno project as an example. So they're actively doing this. They're actively under construction. We're going to say that it's a 40% discount, just conservatively. Actually, let's say 50%. Some of them may go 50%, but let's just say 50% because it's easy to do the math. So you got $1 million gain. You put it into that deal, it's going to be worth $500,000 as of December 31st, 2026. So when you do that, you're going to write down your original gain to $500,000 because you're paying the taxes on it as of December 31st, 2026. You now have basis up to $500,000, not to $1 million, which is what you originally put in. Your basis is at $500,000 because that's the amount that you paid taxes on. And so when you go to, right, so now as it relates to depreciation flowing through, so when that thing gets put into service, the only depreciation your amount you're going to be able to take is up to $500,000. You won't be able to take it to the full $1 million. Now, interestingly about that, right, so for purposes of like your basis as it relates to the IRS, which is outside basis, now you're going to have a $500,000 outside basis. Your inside basis is, I think, I'm not an inside basis expert by any imagination, but I think that still remains at $1 million. So when you go to get your cash and your allocations of actual revenue, then they're going to return your capital up to the $1 million amount, and then you're going to get your whatever 8% preferred return, and then you're going to get your splits on top of that based on the full $1 million. But there's a difference between what your money is as it relates to the partnership, your inside basis, and your outside basis as it relates to the IRS. And that's going to go down. So great question, Blair. Appreciate you hitting that. All right. So Arthur's asking, can we help strategically develop a new rural OZ project and help to find investors? We have done that. The find investors is the biggest challenge, Arthur. So yeah, we absolutely help people with strategy relative to their projects all the time. And we actually jumped in and did, like, we became GPs on a couple of different deals when we first had our fund. It ends up becoming a whole lot of work. And so we're very careful about doing that right now. And I don't believe that we've got bandwidth to be able to do it, just because we've got so much compliance work that we have to do right now. And so actually being able to help somebody raise money and find investors would be fairly difficult for us. That said, we do have Ascent, and we've got the ability for people to be able to interact in Ascent. Ascent is our weekly mastermind that meets on Tuesdays from 10 to 11:30 Eastern. And inside of that group, there are people that are interested in finding deals. And you can also put your project inside of the deals section inside of Ascent. So we're not actively helping, right, where we have that as a service where we help people find investors, but you can find investors through our stuff. It's just kind of through our regularly offered products. And that would be up to you to source the people that might be interested in it and then get them closed. All right. Let's go into the Q&A and see if there's any in the Q&A. I think that I might have gone through these, but I want to make sure that I did. I should have hit those or just marked them off so that way I could really fast go through them. But I think that we hit them all, and appreciate everybody being in here today. It's as always, it's an honor and a privilege to be able to do this with you guys, and this is why we do these live, because your situations are where the rubber meets the road. So here's where to go from here. Whatever your situation is, the gain, the deal, the fund, the client, go to ozpros.com/connect. You just saw the thing flash up, and tell us where you stand. Just the shape of it. It doesn't need to be polished. We'll read it and we'll point you in the right direction. If you're the type of client that would just prefer to get on the phone and talk it out, book the free 15-minute call on the same page. It's not going to be a pitch. It's not going to be a pressure. We're just going to try to walk you through and get you into the thing that's going to be the best help for you. One last reminder on the dates. If there's a 2025 K1 gain anywhere in your world, early September, that's September the 10th. That one can't wait. And make sure that you guys get your QOF returns, your 8996s filed with your partnership returns by September 15th. On everything else, the fall rush is not a maybe. I just did a video about the CNBC article. They said that there's $75 billion in deferred gains coming due December 31st. There's 41,000 investors. And I actually think that the number is double that as it relates to deferred gains. And so every one of those investors there's not a whole lot of us out there. And we're already busy. So the people who move now get the runway to do this right. The people who call in November, I hope that we can serve you, but I can't guarantee it. So this replay is going to land in your inbox. Share it with somebody who needs it. Thanks for hanging out with me today. Appreciate you guys being here. Sherpa, out. Cheers. Oh, wait, hold on. We got Lee asking a final question in here. And we just, I'm going to put it back on here. If we purchased a building in an opportunity zone last month, can we create a fund after we have closed? What are the options? We have a company we can partner with that will occupy the building as a QOZB. Lee, I'm really glad that you're here. Hopefully you're going to be in Ascent on Tuesday. But the answer is it depends on how what you used. If you purchase the opportunities, if you purchase that building in an LLC, and we can now turn that LLC into a partnership before you file taxes, absolutely. And it just, especially if it was last month. And so we can now create a fund, put your capital gains in, and then recapitalize the QOZB. So yeah, we can absolutely do that. So let's make sure that we get you going. Reach out, go to, email us. I think that you've got all our contact information and everything else. But yeah, let's make sure that we get you squared away. Once again, appreciate you guys. And, take action. If you take one thing from this, it's, man, let me go and make it happen right now. Let's get this going because it's going to start stacking. Cheers, guys. Have a great week.